Welcome back. You're with Power Lunch. You're on NDTV Profit. A market check before we proceed. Nifty 50. Well, actually, you could say it's holding on. It's still 0.25% down, 82.18 on the Nifty 50. No major change to report since we last checked. Similar commentary for the Sensex, but the uptick a little more visible. 26,816 on the Sensex, down only about 0.2%. All this week, we have promised you an in-depth conversation with BMR Associates on the implications of the GST Model Law. And today we're welcoming back Mahesh Jaising, partner at BMR Associates. Mahesh, great to have you back. It was a deep dive yesterday into the information technology sector, and today our focus is on banking and insurance and what companies in this space are really gearing up for. I was going through the report that BMR Associates had shared with me on the subject, and what comes to mind is that the impact is really dependent on the pan-India presence and the product mix. But before I jump into details, Mahesh, let's start with insurance, life and general insurance. The implications, in your opinion, of the model that we have for GST.
Yes, thanks. I think, like you rightly mentioned, the fundamental starting point of the issues of GST for insurance companies is the fact that services would now get taxed at a state level, and insurance companies obviously have pan-India operations. So the first thing that needs to be examined, and we've been looking into the fine print and insurance need to take cognizance of, is that they have policyholders across the country. Does it mean that if an insurance company has policyholders in 20 states, do they take registrations in 20 states, or does the law allow them to pay the tax centrally out of their head office, but the taxes go to the 20 states? Because the design of the GST law under the Model GST is such that even if tax were to be paid centrally by, say, an insurance company headquartered out of Delhi, the tax will indeed land up going to the 20 states where the policyholders are actually based in. So the first thing that insurance companies need to do on the life side, and then we'll get to general insurance, is to have a robust mechanism to be able to figure out the address and details of the individual policyholders. A reading of the Model GST law, in fact, suggests that the law allows you to just go by the bona fide declaration. So the insurance company doesn't necessarily have to go into great depth of review to check if the PIN code is correct or not. And tax then needs to be paid, IGST tax needs to be paid account to state 1, state 2, state 3, up to state 20 in the example I gave you.
Okay.
Moving on. Oh, yeah, sorry.
No, I'm sorry for interrupting you. Mahesh, please.
Yeah, so I think the life insurance sector and even the general insurance has another very unique fact pattern, that the law requires these insurance companies to pay the tax on the agent's commission. So way back since 2002, the levy of reverse charge, if I may use the word, is applicable. So insurance companies have hundreds and thousands of agents. They roll out commissions to them. The law has always made the liability to pay the tax on the insurance company because it's easier for the government to administer and recover the tax from the insurance company itself. So building on the last question that I raised, that on the output side, the insurance company would need to literally split contracts or split the details across all the states. Even on the input side, would they need to map commission agents billing statewise? I think the answer is yes, but there seems to be some flexibility of them being able to pay the taxes centrally.
Okay, so one piece is the insurance, life insurance policy holders. The other piece, of course, is the commission agents. And those are the two, conceptual buckets that companies will need to address in the context of GST. That covers the insurance piece. And now I want to really deep dive into the banking piece. When it comes to the banking sector, what are you telling your clients in the banking space? The top 3 or 4 areas that they need to brace for change?
I think the top 3 or 4 areas that they need to be geared up again is on the back of, taxation at a state level. That is sort of de minimis for all service sectors, including banking. But if you look at the banking sector, the predominant revenue of banks is interest, and interest has been kept outside the net of service tax. We also expect that to be outside the net of GST as well. So moving on, what they really need to look out for is how do they tax other transactions other than interest, because one of the definitions in the fine print suggests that services includes an actionable claim. So we need to watch how the transactions of actionable claims, so securitization of unsecured debts that happens between banks, is that going to be taxed going forward? And even if it does get taxed, again, that will have to be mapped at a state level. So really, banks need to start looking at their revenues a little bit more closely to slice it into state-wise. So I would say interest is one bucket, securitization is another. Transaction of foreign exchange between interstate banks is something that we need to look out for. The current law allows an exemption, and also the current law allows a composition when individuals like you and me or corporates buy foreign exchange. There is a mechanism that they just charge the tax on a composition basis. The current model draft GST law does not have that. So I would think on the core banking activities, there are 3-4 areas which banks need to look at and take back to the government as advocacy and take it forward. I will cover cross-border transactions in a few minutes, but I think for now, from a banking sector, these are the top 3-4 areas that they necessarily need to map, Manvi.
Okay, I just wanted to actually address cross-border transactions as well, but just this is a pretty crucial one. Absolute clarity from the government on the service tax-free status of interest income, right?
Absolutely, because if you look at any bank, the larger banks and the PSUs, all the banks, clearly 75% plus would be of interest revenue, and clearly we need certainty that that would not get taxed. I would be very surprised if it is otherwise, but needless to mention, that would be item number one in my list of what banks should be asking clarity for under the law.
I have to say, on a slightly lighter note, Mahesh, I'm always intrigued that so much clarity has to be sought always. It's not automatically delivered. Let's talk about cross-border transactions for multinational banks. What does it throw up?
So, in terms of cross-border transactions, the general thumb rule is exports should not be taxed and imports should be taxed. This is the basis of taxation not only in India but pretty much in most parts of the world. With respect to banking sector, we have seen that there have been some exceptional transactions called intermediary services where a bank plays sort of a facilitator role between an overseas party and a particular company in India. The current law has some ambiguity, and in a nutshell, what would ordinarily qualify to be an export in the current law does not qualify to be an export. So here's some good news. The Model GST Law does address some of this, and it appears that mostly all of the transactions that get billed to overseas customers should indeed qualify to have an export status and be zero rated. So that's the good news from a cross-border standpoint, that we should have transactions that are billed to overseas entities, pretty much all transactions getting an export status, and import transactions having a reverse charge. Now, the only exception to this rule is that the export and import definition of service says a transaction interstate two establishments of a same entity will not qualify to be an export or an import. So it's quite common for multinational banks to have branches in India, and therefore one needs to read this a little bit more and understand, and going back to your observation, more clarity. But what would happen between transactions from a branch, billing and head office? So one breath, it may not qualify to be an export and it may not be taxable. So while it's not taxable, it will break the credit chain. So I would think that cross-border transactions, there is some amount of simplicity that seems to have come about in the Model GST law. But where there are transactions between branches and head office, that's an area that needs further engagement and resolution. Otherwise, there would be some problems around that.
So actually, from what you've just said, Mahesh, it seems that for now, you got to sort of temper the good news when it comes to, all billings to overseas entities getting an export status. got to hold your breath on that one for the moment. Let's take a step back and say, okay, so you've got banks, they have pan-India operations. Just in terms of how they're going to be approaching GST, what's the work that needs to be done? What are the challenges it throws up?
So I think the first thing that banks need to gear themselves up is they need to take state-wise registrations. Even if the law allows some level of flexibility to pay taxes centrally, each state, every bank or even insurance companies have offices across the country. They incur costs like rent, telecom, so on and so forth, which will indeed attract a local GST in those states. So what banks need to do is to get decentralized registrations, avail credits at a state level. If the law does allow us to transfer the credit to the head office, we will be able to do that, but de minimis would be to take a state-wise registration, because the last thing any business, a bank, insurance, or any business for that matter would like to do is to lose out a possibility to avail a tax credit and expense it off. So I think that's the first and foremost thing that banks would need to look at.
Does this have any credit implications for banks, Mahesh?
Yes, it does. I think the emphasis on indirect tax and GST as we evolve and get through the teething troubles would be 20-30% of your time would be on output taxes, but 60-70% of the balance would be managing your input tax credit. So what the whole GST and the Model GST Law reaffirms is the framework of tax credits getting built up statewise. So we need to, banks need to look into the fine print and figure out methods to be able to ensure that the credit pool that's built up is indeed available for effective utilization against output liability. At this juncture, Manvi, it will be relevant to note that the current law allows a 50% credit method, but the new law does not talk about a 50% credit method. We don't know if the government will prescribe that. When I say 50% credit, it means that the bank simply assimilates all their expenses, all the tax credit, and avails only 50% as things stand today. That's an option that's available. But going forward, we don't know if that's going to be there and whether banks necessarily need to avail a credit in a formula method, which will be a little bit complicated.
Mahesh, I reckon you've got your hands full in the months ahead as answers and clarifications are sought on many of these fronts. As always, thank you very much for joining us on NDTV Profit, and we look forward to our continued partnership with BMR and Associates as we examine the impact of the Model GST Law on various sectors of the Indian economy. Thank you, Mahesh.
It's a pleasure. Thank you for having me over.
After the break, we change gears. Jean-Christophe Letelier, Managing Director of L'Oréal India.